Good morning and welcome to TOI Japan Market Radio for Wednesday, June 10, 2026. I'm your host coming to you from Tokyo, and this is your daily briefing on Japanese markets designed specifically for global investors tracking Japan exposure. Joining me today is our portfolio manager and Japan macro specialist. Let's dive straight into how Tokyo traded overnight.
Thank you. We saw a mixed session in Japanese equities today. The Nikkei 225 closed up 0.242% at 64,179.27, showing modest resilience. However, the TOPIX told a different story, down 1.307% to 407.8, indicating weakness in the broader market. The Mothers Index, which tracks smaller growth names, fell 1.823% to 2316.0. On a brighter note, J-REITs gained 1.006% to 1807.0, likely benefiting from yield-seeking flows. USD JPY edged higher by 0.16% to 160.43, while crude oil rose 0.896% to 88.99. Gold in yen terms dropped 2.8% to 15,970.0, reflecting some risk on sentiment in certain pockets.
So we're seeing divergence between the Nikkei and TOPIX, which often signals index composition effects rather than broad market strength. Before we unpack that further, there's an interesting headline that caught attention earlier today. Reports suggest the Nikkei 225 surged 0.91% to 66,934 in what appears to be an intraday or separate session reference, driven by a SoftBank AI announcement and renewed semiconductor demand. Can you walk us through what's happening here with these tech-driven moves?
Absolutely. This reflects positive momentum in two strategically critical sectors for Japan. First, SoftBank made a significant AI-related announcement that's being interpreted as a signal of continued innovation and capital deployment into high-growth technology areas. Second, global semiconductor demand remains robust, and that matters tremendously for Japan because companies like Tokyo Electron, Sony Semiconductor, and Shin Etsu Chemical hold substantial positions in the global supply chain. These are export-oriented, capital-intensive businesses where sustained demand translates directly into earnings growth.
And from a market impact perspective, how should global investors think about this development across asset classes?
For Japanese equities, this is constructive near-term momentum. Semiconductor and tech-related names are likely to outperform, and strong demand trends typically lead analysts to revise earnings upward. Importantly, this isn't speculative froth but genuine earnings drivers, which is what you want to see in a sustainable rally. On the yen side, risk on sentiment combined with export demand usually provides modest support for yen appreciation, though the magnitude depends heavily on global yield differentials. For JGB yields, equity strength can create slight upward pressure as investors rotate out of safe haven bonds, but Japanese yields remain structurally constrained by BOJ policy and demographic factors.
That's a helpful framework. Now, staying with the broader risk sentiment theme, we also saw reports that global stocks dropped ahead of key U.S. inflation data. This seems to be creating some caution in markets worldwide. What's the Japan angle here?
This is critical for Japan watchers. U.S. Consumer Price Index data is one of the primary drivers of Federal Reserve policy expectations, and that cascades directly into Japanese asset valuations through multiple channels. First, if U.S. inflation comes in hotter than expected, markets will price in higher U.S. rates, which typically strengthens the dollar and weakens the yen. That pressures Japanese exporters because their dollar-denominated earnings become less valuable when converted back to yen. Second, Fed rate trajectory influences global risk-free rates, so if inflation concerns intensify, we could see upward pressure on 10-year JGB yields as well. Third, risk-off sentiment ahead of major economic data tends to hit cyclical Japanese equities hardest, particularly exporters with earnings sensitivity to exchange rates.
So in practical terms, what should investors be watching for when this CPI data drops?
For USD, JPY, a hot CPI print could push us toward the 156 to 160 range or even higher, which were already approaching at 160.43. For Japanese equities, specifically the Nikkei and TOPIX, we're looking at downside risk if inflation prints hot and equity volatility spikes. Exporters would be especially vulnerable in that scenario. And for JGB yields, we'd expect modest upward pressure on the 10-year, as Fed expectations anchor global yields higher. The bottom line is that this CPI release is a critical macro variable determining both Japanese equity attractiveness and yen dynamics in the near term.
It sounds like we're caught between two narratives right now: domestic strength in semiconductors and AI-driven tech on one hand, and global macro uncertainty driven by US inflation concerns on the other. How do you reconcile those two forces?
That's exactly the tension playing out in markets today. The divergence we saw between the Nikkei and TOPIX reflects this push and pull. The Nikkei, which is heavily weighted toward large-cap exporters and tech names, managed a slight gain, supported by the SoftBank and semiconductor stories. But the TOPIX, which captures the broader market including financials, domestics, and smaller caps, fell over 1.3%. That tells us investor conviction is narrow, focused on specific growth stories rather than broad-based risk appetite. When you see that kind of divergence alongside weakness in the Mothers Index, it's a sign that global macro concerns are dominating sentiment for anything outside the top-tier names.
Meanwhile, in corporate news, we also saw a separate headline simply stating that Japanese stocks closed lower, which seems to align more with that TOPIX weakness you mentioned. What's your read on the session overall?
Right, and this is where context matters. A decline in Japanese equities can reflect several underlying concerns: domestic earnings weakness, international risk-off sentiment, yen strength reducing export competitiveness, or shifting monetary policy expectations. Given Japan's export-dependent economy and the importance of equity valuations to domestic financial stability, equity weakness always warrants monitoring for broader economic implications. In a risk-off environment, we typically see yen strength as it acts as a safe haven asset, though that depends on whether the selling is Japan-specific or part of a global move. And as I mentioned earlier, risk-off conditions generally lower 10-year JGB yields as investors rotate into safe assets, putting downward pressure on yields.
Shifting back to equities for a moment, the J-REIT performance stands out as a bright spot today with that 1.006% gain. Is that purely a yield story, or is there something else at play?
It's primarily a yield story. In an environment where equity volatility is picking up and investors are cautious ahead of major data releases, yield-bearing assets like J-REITs become attractive. They offer relatively stable income streams, and with Japanese government bond yields still structurally low despite recent moves, real estate investment trusts provide a compelling alternative for income-focused investors. The fact that J-REITs rallied while broader equities struggled suggests defensive positioning and a hunt for yield, which is classic risk-off rotation behavior.
On the policy side, does the BOJ factor into any of these moves, especially with the yen trading at 160.43 against the dollar?
Always. The BOJ remains a critical variable for all Japanese asset classes. At 160.43, USD JPY is approaching levels that have historically prompted verbal intervention or actual policy responses from Japanese authorities. A weaker yen benefits exporters in the short term, which partly explains the Nikkei's resilience, but it also imports inflation through higher commodity and energy costs. The BOJ has been gradually normalizing policy, but they're walking a tightrope between supporting growth and managing inflation expectations. If the yen weakens much further, pressure will mount for more aggressive policy normalization, which would have significant implications for JGB yields and equity valuations.
Let's bring this together for our global investor audience. What are the key themes you're watching as we move through the rest of this week?
3 things stand out. First, the US CPI data is the immediate catalyst. How that prints will determine near-term direction for risk assets globally, including Japan. Second, watch the divergence between Nikkei and TOPIX closely, because it's telling us something about where investor confidence actually sits. If that gap widens further, it suggests defensive positioning is intensifying. Third, keep an eye on USD, JPY around these 160 levels, because any move toward intervention territory could create sharp volatility across Japanese equities, particularly exporters. The semiconductor and AI story is structurally positive for Japan, but near-term macro uncertainty is real.
Well said. So for those of you managing Japan exposure or considering allocations, the takeaway is that we have genuine earnings momentum in key sectors like tech and semiconductors, but that's being tempered by global macro crosscurrents, particularly around US inflation and yen weakness. It's a market that rewards selectivity right now rather than broad beta exposure. If you follow Japanese markets regularly and want daily updates like this, please consider subscribing to TOI Japan Market Radio. Thank you for listening, and we'll see you tomorrow.
Thank you.